policy decisions this week. Decisions due from the Fed, the BOE and the BOJ. Global leaders gather right here in New York for the UN General Assembly as US-China tensions simmer and Russia's war in Ukraine rages on. We're also discussing all of that and more this hour with Nouriel Roubini, top economist who has a track record, quite literally, for predicting doom. Danny, let's see if we can shift the tone and maybe raise Nouriel's spirits. It's good to be reunited with you. I floated through Europe to help the economy, but it's good to see you. Back on form, back on the earlies.
I think Europe might need a little bit more help, Manus. Come visit me sometime and do that. But, Manus, like an economist trying to predict where inflation goes next, I've been lost over the past few months without you. It is so great to be back, and on a week nonetheless where we get, what, half of the G20 giving us rate decisions?
Correct. And I think we're going to know over a 36-hour period, really 6 out of 10 of the biggest traded currencies in the world. We're going to understand perhaps the definition of pause, pushback from the Bank of Japan, and maybe even a reinstallation of confidence in the Bank of England. Danny.
Yeah, looking forward to discussing all that and much more with Nouriel Roubini over the next hour, Manus.
Okay, let's set the tone for where we are with risk right now. We've got major headlines on the oil market. This is what we've got for you. You have the Brent crude careering towards $95 a barrel. Now, the question here is the hedge funds. They're the longest that they've been in 15 months. Prince Abdulaziz bin Salman will speak today in Canada. How much more emphasis will he put on the tightness that the IEA and that the OPEC forecasters see themselves? Again, we're debating whether we've hit peak pessimism on China, and that drives that oil market. Euro-dollar was careering lower last week. 9 weeks of losses. We paused for thought, but of course, it was Christine Lagarde who lampooned the euro last week, and the market is now obsessed with one of Nouriel Roubini's mega threats, which is stagflation. Let's ask him how that plays out. Short end of the curve this week in the US as the Fed meets. Will the dots really matter? Will they redefine where we are at the short end of the curve? What will the dots tell us about next year's trajectory in terms of rates outlook for the US? And that, the global consequences of flow on the dollar and around the world, are absolutely material for the back quarter. Danny.
And Manus, one of the consequences of higher for longer, the long pause, is perhaps tech can't perform the way it has been. We saw that on Friday. The NVIDIAs of the world, the Meta, all the big caps tech stocks took a bath. We are looking at a peak higher in S&P 500 futures, but we still haven't recovered the ground that we saw all that lost on Friday. European stocks, they're starting down 0.5%. I love this from Mike Wilson over at Morgan Stanley. He just got back from Europe and basically said that the negative attitude around stocks for 2024, it's not just a U.S. story. People in Europe are also negative. Good to know that we're also pessimistic on this side of the world too, Manus. This one's for you. I know even though you're in the U.S., you're never too far from a European banking story. SocGen falling 7.5%. A couple hours ago, they released a new strategic update. They've cut their revenue forecast. They've cut their profitability outlook, changed their dividend strategy. The market and KBW analysts say they are not too impressed. Manus, I, though, quickly want to go back to oil. You mentioned it. It's near $95 a barrel. We're starting to talk about $100 a barrel. But here's the thing. The oil boogeyman has lost its bite. We got a great chart for you showing that break-evens have barely moved up with the price of oil. And we had UMich survey last week on Friday, and that also showed us that the consumer, their expectations for inflation, Manus, are the lowest since 2021.
Well, I'll see you and raise you in that in terms of expectations, Danny, because if you look at the fissures of confidence, yes, inflation expectations may be slightly behaving themselves, but if you look at FCON, it is tightening. And with that in mind, we've got the surveys out from New York which show that the ability, the confidence to access credit is at the lowest in 10 years. And that is the beginning of the long variable lag in many of its manifestations. And if confidence on access to credit cracks for the consumer, then you begin to understand why Macy's and all the other major retailers were warning on delinquencies a little bit earlier. Danny.
Yeah, we just heard from Walmart last week saying that we're going to be living with higher rates for longer, that there's going to be more inflation sticking around for longer. Walmart is talking about that, Manus. Look, it's certainly a concerning thing. Okay, let's set the agenda. We've got a trifecta of central banks. Those decisions are coming this week. We've got the Fed on Wednesday, the Bank of England on Thursday, and the Bank of Japan on Friday. The Fed
is expected to hold steady as it assesses the effects of its aggressive rate hike campaign. Here's what Bloomberg opinion columnist Mohamed El-Erian had to say about the Fed's balancing act.
They'll pause. I don't think at this point they can hike, but they'll keep wide open the possibility of another hike, and they're going to push back against this notion that they'll be cutting anytime soon. The message will be, we're going a little bit higher, and we're going to stay there for longer.
Let's see what this man makes of it for the next hour. It is Nouriel Roubini, our guest host for the next 15 minutes, CEO of Roubini Macro Associates. Nouriel, good to see you. I know we had to tempt you in to get you up at 5 a.m. this morning.
Pleasure being with you.
Great to have you with us on the first show. So we've got this Fed meeting. All of a sudden, we now are trying to comprehend what higher for longer really means. Will that be manifested in the form of dots, or what does it mean for you as you look forward?
Well, of course, this week they're not going to hike rates, but whether this is going to be a skip or a pause is to be seen. Skip will be a case in which they don't hike, but then leave it open to hiking maybe in November or later. A pause will be a signal that, no, they're done. I don't think they can say they are done because the economy is still growing above potential. Headline inflation is going higher now that oil prices are going higher, and therefore, potentially they have to leave the option open that there'll be another hike.
What is the most misconceived idea? A lot of people have lived through 5% rates before. You have, I have. I've lived through 15% rates, so have you. Is the greatest disconnect in markets that we are pricing 100 basis points of cuts next year, when the reality is inflation is malingering, core CPI is still tight and hot? What's the greatest misconception about inflation?
You're absolutely right. I think that the markets are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against that view. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher, from deglobalization to aging to geopolitics to other negative supply shocks. And therefore, I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case. At the earliest, the Fed is going to start cutting rates maybe towards the middle of the year. Yes?
Danny here in London. Great to speak with you, Nouriel. On that point, look, it's a world saddled with $300 trillion worth of debt. If the Fed isn't going to cut as soon as expected, what happens when we hit that maturity wall come next year?
Well, you're absolutely right. I mean, we live in a world in which there is too much private and public debt. In addition to the official public debt, there is also implicit liability coming from unfunded Social Security and healthcare liability coming with aging. And I think that one of the threats, of course, is not just the trade-off that central banks are facing between growth and inflation, but is actually a trilemma. They have to worry about financial stability. And the more you raise interest rates, and the more they go higher on the short end and the long end of the yield curve, the more there are risks of financial instability. You saw it in what happened in the United Kingdom about a year ago. You saw what happened in the spring of this year with the stresses in the financial system. I don't think we are out of the woods. As rates have to stay higher for longer, the possibility of some degree of financial instability is still with us.
Well, I was going to say, to start the year, there'd been a lot of fear-mongering that QT would perhaps cause that financial instability, but it's gone off with minimal issues, Nouriel. Can the Fed continue on its progress of QT, or will something make them stop?
Well, for the time being, of course, QT has not had a huge impact. Even if long rates have gone higher, they've gone higher in part because growth has been stronger than expected, but that could be also implicitly the effect of having a quantitative tightening occurring, the fact that other central banks like the BOJ will have to phase out their easy monetary policy can put higher pressure on long-term interest rates as well. If inflation stays higher for longer, that's going to also put upward pressure on short and long end of the yield curve. And the higher long rates are, the more the potential for some degree of financial stresses in the system.
One of the mega threats that comes in at number 5 on your chart list is stagflation.
Yeah.
By any measure, Europe is already there. So my question to you is this. I mean, they can't even call the top of rates. Lagarde didn't, Kazakhs didn't over the weekend. How brutal a form of stagflation are we looking at in Europe, given history?
Well, you're absolutely right. I mean, in the US right now, growth is still positive and above potential. In the Eurozone has been either negative or close to zero for the last 3 quarters. And the latest signals coming from Germany and the rest of the Eurozone suggest that the economy is going to be stagnating. At the same time, inflation is still way above target, not just in the Eurozone, but the other case of stagflation, of course, is the United Kingdom, where right now inflation is even higher than the Eurozone and economic activity is slowing down very sharply. So what Europe is facing a situation in which on one side economic activity is contracting, on the other side is inflation is too high. That's what the stagflationary scenario it is. And that's a dilemma for both the ECB and the Bank of England. On one side, the contracting economic activity will lead them to maybe stop at this point. On the other side, if inflation remains much higher than the target, they may have to hike much more. That's a big dilemma, especially for the Bank of England.
Hey, Rubini, but before we get to break, I do want to bring up one point. Last year, you predicted a long and ugly recession for the U.S. That would start last year, continue for this year. We haven't seen that yet. Did you get something wrong there? Is it recession denied or delayed?
Well, you know, most forecasters, including even the staff of the Fed, were expecting a recession. The good news that it doesn't look like we're going to have a real hard landing. Then the question is whether we're going to have a soft landing or a bumpy landing. Bumpy landing being maybe a short and shallow recession. And on that debate, we don't know yet. There are long and variable lags of monetary policy. The Fed might have to hike more. The credit issues might emerge as there is tightening of financial condition. Oil prices higher imply, on one side, higher inflation and lower economic activity, even in the United States. So I would say that whether we're going to have a true soft landing, rather a short and shallow recession, is still an open question, even for the United States.
Nouriel, I'm trying to get the most underpriced risk out of you. From the tone of what you just said, the UK could be there. Confidence in the Bank of England is at a record low by their own survey. It's never been as low. How much are we underpricing what more Bailey and the Bank of England needs to do? How much more of a brutal stagflation scenario is it for the UK? Wrap it up.
Well, you're absolutely right. The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation, and you could have a true stagflation.
OK, the stagflation calls from Nouriel Roubini comes in at number 5 on his charts. He stays with the Bloomberg brief. That's the state of play, Danny, for now. Negotiations are at a standstill, quite literally, like the traffic out there. The UAW calling the proposed 21% pay rise as a no-go. That's on offer to the auto workers right now. What would get them to green light the situation? And in search of bubbles, up next, Nouriel Roubini weighs in on the global AI frenzy. Plus, disappointment for Societe Generale. It cuts revenue and profitability forecasts. Underwhelming strategy update day for the new CEO on Bloomberg.
Is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
We're prepared to do whatever we have to do. So the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind, and especially this past decade, in the most wealthiest times in the history of these companies. There is no excuse. These companies have made $250 billion in the last 10 years, $21 billion in the last 6 months alone. And our workers' wages and conditions have went backwards.
That was the United Auto Workers President Sean Fain speaking CBS on Sunday. The union rejected the car makers' latest offer of 21% pay rise as the strike against the big three U.S. auto workers entered its third full day. Still with us this morning is Nouriel Roubini. Nouriel, Hollywood's on strike. The auto workers are on strike. Europe has its form of angst. Is, again, going back to the underpriced risks, the tail risks, as it were, from mega threats over the next couple of years. For central banks, it's about wages. This is another example of where second-round effects are perhaps underpriced.
They're absolutely so. I mean, there's been a significant increase in income and wealth inequality. The share of labor in income has fallen. The share of capital has gone up. And now that the unemployment rate is much lower in the United States, but also in Europe, workers have pricing power. And fiscal policies also during the COVID recession became pro-union, pro-workers, pro-wages, pro those who are left behind. So I think we're going to see a meaningful amount of labor strife because inequality has been rising and now labor has more power than the past. And that's going to be a source of wage inflation that's going to keep unit labor costs rising more than otherwise. And that implies that most likely inflation is going to be higher than 2%.
Now, look, AI is again on your mega threats. AI and job destruction, it comes in at number 8. What went through my mind when I was preparing to sit down and talk to you was about universal income. How quickly will that begin to be much more of a conscious conversation as AI accelerates? Or is there a considerable lag between AI innovation, NVIDIA booming, and the chip stocks booming, and universal income, real job destruction?
Well, the real job disruption is going to occur over time. There'll be a significant amount of permanent technological employment, not just among blue collars because of robotic automation, but especially among cognitive workers that are white collar. And then there'll be a reaction on what to do about it. The problem with universal basic income is a good idea, but if today you had to give, say, $1,000 to every American per month, only $12,000 a year, that's not much money. It would cost us today, with the current GDP growth, about 20% of GDP, so we cannot afford it. Of course, if over time AI leads to much higher productivity growth and much higher potential growth, we eventually will be able to afford UBI. But from a fiscal point of view, UBI currently is mission impossible. So there's a lot of talk about it, but it's going to take a significant amount of time until we see significant amounts of permanent technological employment, until that idea becomes politically and economically viable.
Nouriel, in the meantime, in a world where labor has negotiating power for higher wages, what does it say about specifically the American project of home shoring? Is it possible if we're in a world where labor in the U.S. is all of a sudden more expensive?
Yeah, you're absolutely right. You know, even if there was, unquote, reshoring or home shoring, the new factories are going to be capital intensive, skill bias, and labor savings. So we're going to have factories with lots of robots and machines, but not that many workers. I think that the benefits are going to go more to some of the emerging markets where the friendshoring is going to occur. Some of their friends are allies in Asia, Mexico, and other parts of the world, because in those countries the cost of labor is lower, and therefore any type of reshoring or friendshoring is going to be labor intensive as opposed to being capital intensive. But the impact, of course, of reshoring on the U.S. Job market is going to be only very modest.
Nouriel?
Okay, so then, Sir Manus, go ahead. You take it from here.
No, jump in.
Well, I wanted to know, Nouriel, about that 2% inflation call. You said we're going to be above there because of these prolonged labor strikes and then the pressure of the nearshoring. How long and how far above 2% do we stay? Is this a fundamental regime shift of inflation in which you're describing?
Yes, I've argued that the era of the great moderation of low inflation below 2% and stable growth is gone, and we're entering an area of what I call great stagflationary and financial instability. Higher inflation is going to be caused both by supply side factors, deglobalization, geopolitical conflict, aging of population, restriction of migration, reshoring, global climate change, pandemics, cyber warfare, backlash against inequality, partial deglobalization. Those are all supply-side factors that reduce growth and increase the cost of production. And on the demand side, we live in a world in which there is so much private and public debt, and deficits are going to remain higher because we'll have to spend more against inequality, against climate change, to deal with pandemic, to deal with inequality coming from globalization and AI, and so on and so on. So spending will be higher, taxes are not going to rise as much, structural deficits will be higher. So either we crowd out growth or have debt crisis, or eventually we have to monetize it, and that's going to cause essential inflation. So both on the supply side and the demand side, there are factors imply that 2% is at this point mission impossible, and the new normal may be somewhere between 3 and 4% for advanced economies. Over time, of course, not overnight. So there are structural factors rather than cyclical that imply that inflation is going to be much higher for the longer term.
Nouriel, dig deep. We've got to get an optimistic call out of you before the end of this show. But hold that thought. Nouriel Roubini, our guest this morning, setting the tone. Coming up, it's been an underwhelming day for the update from the Soc Gen. The new CEO delivered his strategy, and to say it disappointed is a 10% blow on the stock right now. We discuss on Bloomberg. Welcome back to Bloomberg Brief. I'm Menace Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Traders taking risk off the table ahead of a raft of policy decisions this week. Decisions are due from the Fed, the BOE, and the BOJ. Global leaders gather in New York for the UN General Assembly as U.S.-China tensions simmer and Russia's war in Ukraine rages on. And we're going to be discussing all of that and much more this hour with Nouriel Roubini, a top economist who has a track record of predicting doom. Now, there's some doom in at least tech markets to end the day on Friday. It was all the mega cap stocks that got absolutely crushed. We're coming back, but ever so slightly. I mean, this is basically unchanged. We're up less than 0.1% on S&P 500 futures. It's less so in Europe. Things aren't looking great here. We're down about 0.6%. Manis, what is the thing dragging us down? It is Soc Gen. I'll tell you, this thing has been really volatilely trading. We're down about 8.8%. I checked it just moments ago. We were down 10%. It's a new strategic update from the new CEO there. They're cutting revenue. They're cutting profitability. A new dividend way of paying out to shareholders. That's concerning for some, too. BI says that Soc Gen right now trading at crisis-like levels, Manis.
Yeah, and that was probably one of the best interviews we ever did with when he was the head of the investment bank, which was, you know, bonuses for all my friends. They're going to be mega. Yeah. Now he's actually got to manage the business. In terms of cross-asset, taking from that sort of little wobble in the equity market, you saw tech draw down on Friday. But for us, as far as cross-assets are concerned, I'm really focused on the oil market. We're kissing 95. And I like what Halima Croft had to say, which was the strength, the musculature of this rise was something we could barely imagine. Prince Abdulaziz bin Salman, the head of the Saudi oil delegation, will talk today in Canada. What will he say that will drive the view of deficits higher? The hedges are long as you can be for 15 months. We're at a 15-month high in terms of the hedge fund exposure to the oil market. So kissing that $100 is not hard to do. Now, when it comes to euro dollar, we were down for 9 weeks in a row. Stagflation. We've just had 30 minutes with Nouriel Roubini. Again, redefining what stagflation is in Europe. But the euro is down. By the way, they're loading up the longs on the dollar. Is that because of a potential shutdown? Is that because of stagflation and the lack of growth in Europe? Which then takes you squarely to the short end of the curve here in the States as we go into Fed on Wednesday. Now, this is where we need to really begin to understand what is higher for longer. What is the view from the dots? Will there be another hike in the dots this Wednesday? And will it show a number of cuts, 3, 4 cuts next year, because that is important. The differential between 3 and 4 is pretty immense in the market steepening, the bull steepening that's been going on. Short rates above 5% for the moment, Danny. But there we go. It is about stagflation. Who is wearing the worst shirt of all in terms of growth and inflation? And that's a big call, and that's the 2024 narrative.
Yeah, and look, we've been spending the past hour with Nouriel Roubini. If you've missed it, first of all, shame on you. But second of all, our great Bloomberg News team has already written up Nouriel Roubini's thoughts that he just shared with Manus and me about stagflation, about what you're talking about, Manus. What stuck out to me was Nouriel saying that the BOE should hike to 5.75%. Just get it done with, and with the dovish language. But that's needed in order to avoid stagflation. But that's not really what we're hearing from Andrew Bailey. We're hearing a BOE governor who has been talking about getting to the top of the mountain and what that mountain might look like.
Absolutely. And I think when it comes to the stagflation narrative, the other thing that we took away from Nouriel was about the UK. Maybe they don't have the wherewithal to get to the 5.75%. I encourage everybody, go back and look at Sky TV yesterday in the United Kingdom. They played out a piece from the former Bank of England governor, Mark Carney. Surreal what he said, which was Liz Truss and her cohorts tried to deliver Singapore on Thames. What they delivered was Argentina on Thames. And that is a rebuke from a former central banker. Sterling under pressure, cable 123.95. When I left the Middle East last week, I was thinking about switching money. We're trading up at around 125. The pressure on sterling is tough at the moment. Danny.
Manus, you live in America. You're not allowed to be plugging
God
Sky
bless
News
America.
anymore.
I have arrived. I have arrived. The promised land.
His viewing taste might not have changed yet. I'm sure those will catch up. We'll get you watching the Kardashians in no time, Manus. All right, let's shift gears and talk about Wall Street. Strategists there have been largely wrong about this year's stock rally, but they're starting to face their mistakes. Strategists at SocGen, Piper Sandler, BNP Paribas, they're all raising their 2023 calls. Some, of course, are still bearish, Morgan Stanley's Mike Wilson being among them. Let's get back to our conversation with Nouriel Roubini, CEO of Roubini Macro Associates, who, of course, is the author of Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them. All right, Nouriel, last time you were on Bloomberg TV, you talked about a 10% decline in equities. We're going to switch up the pace. Fast answer, rapid fire here. I want to get to that call. Tell me where you land on stocks at this moment. Would you want to be shorting or going long American stocks?
For the rest of the year, I will be shorting U.S. stocks.
All right. And is that a 10% decline? Is that still about where you think we could land?
It's highly possible, given what's happening in the U.S. and the global economy, and rising oil prices and inflation being still sticky, and the Fed and other central banks not being done yet.
All right. Is that a call just for American stocks, Nouriel, or globally, are you looking dour on equities?
Well, in the rest of the world, it's even worse than the United States. In the U.S., you might have a bumpy landing, but in the Eurozone and the UK, we're talking about inflation and recession, stagflation. China is slowing down sharply, so the rest of the world is even worse than the United States, I would say, in relative terms.
I'm going to get a bullish call out of you. When do we hit $100 in oil, will we?
I don't know if that's bullish. Might be bullish for the oil market. It's not bullish for inflation. It's not bullish for growth. It'll be pretty bad. It's another stagflationary shock. You know, when oil prices go higher because there is stronger demand, that's consistent with economic activity being stronger. But if it's a negative supply shock because Saudi and others are cutting supply, that causes a greater inflation, lower growth throughout the world. So that's actually bad for the global economy.
Where do you see oil going to, Nouriel? Where's the upside on it?
Well, it depends, it depends on what happens on the supply side. If the OPEC Plus keeps on restricting supply, oil prices can go higher. But I would say that if global demand is going to soften because you have Europe in a recession, China slowing down, even the US are going to slow down, eventually probably there'll be some correction to these oil prices on the demand side.
Nouriel, I'm going to try again for a bullish call. I know Manus was trying to do it. It's our first show. We got to be positive about something, Nouriel. Yeah. Take me to the FX world. What currency pair would you want to be long right now?
Well, for the time being, I would say the dollar, because in relative growth terms, the U.S. is going to do better than Europe and rest of the world. But I would say that because of that growth differential and because inflation might be falling in the U.S., probably the Fed might be the first central bank to eventually fully pause and then start cutting rates. And that's going to imply that, say, by next year, the dollar might weaken because of the relative interest rate differential expectation between United States, Europe, and what's going to happen in Japan, where they have to phase out the YCC and normalize policy rates. So in the short run is a bullish dollar call, but over the medium term, actually, there are factors that are going to lead to a weakening of the US dollar.
And then in that longer term, too, then, is it a long yen call? What do you need to see also from the BOJ to get to that place?
Well, I would say that by the end of the year, they might fully phase out the yield curve control. They are already talking also about phasing out the negative interest rate policies. It's the only advanced economies right now is still negative policy rates, and as gradually short rates go higher, long rates go higher, that should be strengthening the yen that has been quite weak, of course, because of the differential in monetary policy between the BOJ and the rest of the advanced economies.
Let's just pivot briefly to the Chinese market. Some people are saying we've hit peak pessimism on China from an economic point of view. That's got a consequence for the yuan. Your call on China and yuan?
Well, the problems of China are not cyclical. They're more structural. Potential growth used to be 10% and down to 5%. Today probably is no better than between 3 to 4% because you have massive aging of population. You have huge amounts of private and public debt. You have a overhang of real estate. You have a state capitalism galore under Xi Jinping. The sentiment of the private sector, households, and the private corporate sector is really foul because of the policies of China. You have geopolitics going to restrict both inflows of FDI and exports by China, and they're doing everything wrong in terms of policies. So I would say they'll be lucky if they have 4% growth over the medium term. 3% is more likely. Therefore, the issue of China is not just cyclically that the economy is weak, but structurally is weak.
We're going to spend tomorrow on private equity and credit and debt. So let's get your call in terms of, do you want to be longer of bonds and duration relative to debt